Right, good morning everyone and welcome to Xchanging's full year 2014 results meeting. And for those of you who may not have been here before, welcome to Walbrook, where we've been for not quite a year now. So it still feels very new, and it's certainly the first time that we've presented our corporate results from our own auditorium. I just would like to say just a couple of housekeeping bits. Please, if you've got telephones, could you turn them off or mute them? If there is a fire, you'll be shown where to walk through these doors, and the fire marshal will show you how to leave the building. So we are recording today's events for people who are unable to attend, and when we get to Q&A, I'll be taking questions not just from the floor but also from people calling in. So without any more ado, I'd like to introduce you to Ken Lever, our Chief Executive, to talk you through the results, and David Baumfeind, who will follow with the financial section of the results. Ken, over to you.
Thank you, Lexi. And good morning to you all. I'll add my welcome to Lexi's. Very good to see you all here today. We're going to have a slightly different agenda today than we would normally cover the results. I'd like to talk about where the company is today, where we've got to. Then I'm going to spend a little bit of time just giving a review of the year, so cover the good stuff and the not so good stuff. Then David is going to go through the financials. Then I'll come back and I'll talk about business development and strategic direction of the business, and then conclude with the summary and outlook. So those of you who followed the Xchanging story will know that since 2011 we've been on a transformation journey to move Xchanging from a business built around a few customers and large business process outsourcing contracts into a company with a broader customer base and a focus on product and service offerings based on innovation and technology. So today we have an integrated business which is now well positioned for growth, particularly in technology and procurement. So we've achieved full ownership over that period of the businesses where we want full ownership. So there are no remaining enterprise partnerships as such. We still do have one or two partnership and joint venture relationships where we want those relationships to exist. We've assembled a technology platform for procurement, which was built around the acquisition of Market Maker 4, and we have refocused the procurement offerings. We've given clear direction to our technology business, so that's now built around the insurance software and also application services. And we've significantly reduced customer concentration risk as a result of a number of the large contracts moving out of the group. Finally, we've substantially improved what I call the organisational capability of the business. So we've invested very heavily in the sales and marketing area and also in developing the shared services for the business. So over this period, we've really moved from lower margin BPO to higher value technology offerings, and this is reflected in the steadily improving margins of the business. Now, inevitably, as a result of the various strategic and commercial decisions we've made, there's been a decline in revenue, particularly around the decisions such as the exit from Xchanging Transaction Bank, which was the relationship with Deutsche Bank, and also the exit from ex-HRS. But there is actually underlying growth in the profitability of the business of over 20% once you take into account the run-off business which has exited the group. We've also invested heavily, as we said we would, and this has clearly impacted cash flow and our net cash position. If you do cast your mind back to this time last year, we did set ourselves a fairly significant challenge, and I remember one of the headlines of one of the analyst notes was about backing ourselves, And the challenge we took on was really to maintain the adjusted operating profit of the business against the backdrop of a significant amount of profit moving out of the group, and we have achieved that. We also said that we would invest in growth and the infrastructure of the business, and we've certainly done that. And we also committed to resume growth in revenue and growth in profit in 2015. So in 2015 we intend to show that we can grow the business with our chosen offerings in our chosen markets. So what went well in 2014? Well, we continued our involvement with the Central Services Refresh Programme in the London insurance market. So this is all part of the market modernisation programme, and we're very much front and centre of that. We acquired 100% ownership of Fondsdepot Bank in Germany. That's within our financial services business, and we renewed ahead of time the relationship with AGI. We've seen significant growth in the revenue of our application services business. We of course completed the acquisitions of AGENCYPORT and Total Objects, and then invested in this technology platform for procurement. So one of the areas of investment we identified last year was really to build on the Market Maker 4 platform, which we've done. And you may have seen another announcement this morning. We've actually just completed the acquisition of Spikes, which is a spend analytics business in procurement. We've seen excellent progress with Market Maker 4, substantial growth in revenue of that business, and we've made good progress with the Everest Re implementation. So this is the Zuba implementation in North America in reinsurance, which will be a sort of flagship installation for Zuba in the US. And finally, we were successful with a very major brokershore implementation with a major broker here in London. There have, of course, been some disappointments, as inevitably there are. We weren't able to completely mitigate the impact of the decision by Hong Kong Exchange to take in-house the business, the managed service business, which we ran for the London Metal Exchange. We had a good go at doing that, but we didn't quite manage that. We saw slower progress than we might have hoped with NetSet, but we've established clear priorities for that for 2015. And also, we were a bit disappointed that we didn't achieve more Zuba wins in the year. I mean, there's a very long sales cycle on Zuba. It's a big strategic investment for potential customers to make. And it's not as if those opportunities have gone away in the sense that they went to other providers. It's just that the decisions have not yet finally been made in some of those companies. And so many of those opportunities we still pursue today. Significant disappointment was not being selected for New South Wales workers' compensation. We made the decision to invest in that. We felt that it was the appropriate thing to do for our business, but unfortunately, as we were one of the smaller agents in terms of market share, finally when the decision was made, the two bottom agents were eliminated. Now, had we known that was going to happen at the outset, we may have taken a different course of action. But nevertheless, we competed well, but sadly we didn't win that business. And then finally, of course, the CMA referral, this is the Competition and Markets Authority referral of AGENCYPORT, which not only is disappointing, but was actually extremely surprising. And that's something which clearly we'll see the progress of that as we go through this first half of the year. So I said at the start, we'd embarked on a journey of transformation in 2011, and to my mind that transformation is actually now complete. We are a business technology and services provider as a company. There's still more that we have to achieve to prove some of our offerings in the market, and there's more for us to achieve to drive more growth in some of our businesses. And there's certainly more for us to do to demonstrate a return on the significant investments that we've made. But one thing's for sure is that the business is in significantly better shape than it was 4 years ago. So from my perspective, we're very much fit again, which is really one of the objectives we were pursuing. We are aggressively competing to win, and to use our analogy, we've rebuilt the car tuned the engine, and now we're on the road to growth. So David will just cover the financials.
So thank you, Ken. Good morning, everyone. So as Ken said, we entered 2014 with the challenge to make up the shortfall from the disposal of the XTB and the other contract reductions. We did deliver on our objective of achieving the same operating profit as last year. So there's a lot of analysis in the prelims and in the appendix to the presentation, but I'd like to take this time to focus on the key themes. So looking at the revenue bridge, the XTB disposal and contract reductions we've highlighted over the last year have reduced revenue significantly, especially in business processing services. In addition to the highlighted contracts, we saw an acceleration in the timing of the expected reductions in claims and broking services. As Ken has said, we now have better visibility over our future revenues. So looking at the income statement, there was a number of cash and non-cash exceptional items in the year, largely associated with the completion of the transformation programme. Although all the items have been highlighted during the year, I've included full details in a slide to the appendix. In 2014, earnings per share benefited from an effective tax rate of only 14.9%. The rate is lower than predicted at the half year due to the recognition of a deferred tax asset for brought forward losses in Italy, as we can now see profits in this business for the foreseeable future. This has reduced the tax rate by 8% in 2014. We would expect the normal effective tax rate to be in the mid to low 20s percentage points. So turning to look at investment in 2014, in addition to the two insurance software acquisitions, Total Objects and AGENCYPORT Europe, for a total of 75.6 million up front, capital expenditure in the year was 46.7 million. Given the level of organic investment in the year, I'd now like to take some time to highlight the most significant investments we're making, starting with our internal change programme. 2014 has been a pivotal year for our internal change programme. Shared service centres have been established both onshore and offshore for functions such as sales, finance, HR and IT. We invested in technology to enhance our management information systems and drive performance and cost efficiencies. We've started a finance transformation programme which will provide a single global finance system for the group. The majority of the investment is complete, and from being a series of businesses built on a patchwork of legacy systems, we're becoming a fully integrated business, largely using cloud-based technology in the back office. As a result of these programmes, we expect to realise benefits of over 5 million by 2016. These are the quantifiable savings in direct costs. The intangible benefits from having common platforms across the business to which we can easily integrate new contracts and acquisitions, as well as increase efficiency, comes on top of these quantifiable benefits. So turning to look at investment in product development, our largest investment has been in our Zuba product range, where we've accelerated the development of the strategically important US admitted module. We've invested in our services for the London insurance market and are also further developing our procurement technology, building on the MM4 software framework. The recent acquisition of Spikes Cavell provides a key piece of functionality for our developing technology-based procurement business. The growth in revenues resulting from these investments were modest in 2014, and we expect the benefits to increase going forward. So I'll now look at our cash performance for the year. I've previously stated that we should be able to convert around 80% of our adjusted operating profit into operating cash flow. The reason it's not 100% is because of the dividend payable to non-controlling interests, which we recognise in operating cash flow. In 2014, we agreed a new deficit recovery schedule of over 10 years for our large Rebus pension scheme. And as a consequence, I would now expect our target cash conversion to be around 75%, depending on where we are in the capital investment cycle. The execution of our business transformation plans has resulted in a number of items that have reduced our reported cash generation in 2014 and will continue to do so in 2015. In 2014, as well as the increase in capital expenditure, working capital was impacted by the mid-year acquisition of AGENCYPORT, as much of their revenue is collected in the first quarter of the year. Our operating cash flow also includes a one-off transfer of 3.2 million made by Fonds Depot Bank into a trust arrangement to fully fund its pension liabilities. In 2015, as previously stated, approximately 15 million of working capital associated with the BAE Systems UK procurement contract will unwind in the first half of the year. In addition, during the year there'll be a cash outflow of 8.9 million from the restructuring provision that we created in 2014. We expect the combined effect of these items to impact operating cash flow in 2015, before returning back to around 75% in 2016. So I'd now like to review the performance of each of the sectors. This table shows that we've seen a reduction in the corporate costs in 2014 as we've benefited from the efficiency improvements highlighted earlier. While we expect further improvements in the sectors, we do not expect there to be room for further improvement in the centre in the near term. So turning to the sectors, I'll start with the largest, Business Processing Services. BPS continued to perform well as the sector benefited from growth in London market volumes, another good performance on the Victoria contract and a well-managed cost base. However, claims in the UK and New South Wales suffered setbacks. The London market claims adjusting contract reduced in scale during the year and came to a close at the end of the year. As you know, the New South Wales contract will end in 2015. Although new claims business has been won in both London and Australia, this will not fully replace those contracts. Together with a reduction in the onshore element of the broking services contract with Aon, the impact of these reductions on revenue from 2014 to 2015 is around 28 million. Just as we did in 2014, we've plans to protect insurance margins through this last part of the revenue reduction in insurance, partly through growth and partly through further cost efficiencies. Turning to financial services within BPS, the underlying business in Germany, Italy and India improved revenue and margins on a like-for-like basis, following the disposal of the XTB and its profit of 10.5 million partway through 2013. Now that we own 100% of the investment accounts administration business in Germany and have recontracted to manage the 1 million accounts directly, we've secured the last significant area of revenue risk in the financial services business. Looking at the BPS sector as a whole, we expect to maintain local currency profitability during 2015 despite the revenue reduction by focusing on higher margin service, investing in automation and closely managing our cost base. This will position the sector well for a return to growth in 2016. So now turning to the technology sector, 2014 was a year of transformation for the business. The conclusion of the LME contract in May led to significant reductions in revenue and profit. However, the sector is making good progress in developing its other business areas, in particular in application services. Our application services business continued to grow in the year and now constitutes a significant part of the technology sector. Since its acquisition, AGENCYPORT has performed well, with net revenue of 10.5 million and profit of 2.8 million for the 6 months post-acquisition. Total Objects was acquired on 18th of December, and its results post that date have not been included within the group's results due to materiality. More information on the acquisitions is included in the appendix. Turning to procurement, this sector also experienced a lot of change in 2014. We entered the year with a reduction in revenue and profit due to the decision to exit the HR business that was returned to BAE Systems at the end of 2013. This reduction was partially offset by the additional revenue from MM4, which we acquired in late 2013. MM4 revenues grew by 60% during the year. In the second half of the year, under the new leadership of MM4 founder Chirag Shah, the procurement sector achieved material sales awards that will set it up for growth in 2015. During the year, we invested 1.5 million in the MM4 platform and have also taken steps to restructure the operations and reduce the cost base within the overall procurement business across Europe, Australia and the US. So in summary, during 2014, we invested in our infrastructure, in acquisitions and in product development to position us to grow from 2015. During this year, we're focused on executing the plan to deliver this growth. That brings us to the end of the financial section. Thank you for your continued interest. And now I'll hand back to Ken to talk about business development and the outlook.
Thank you, David. So I said in my opening remarks that Xchanging is a business technology and services company. And what we aim to do is try and address the customers' most complex processing challenges through innovation and technology. So we now see ourselves as having a business which, through innovation, technology, customer, industry insight, provides differentiated offerings which address the operating and processing challenges of our customers and adds value clearly to their businesses. What we now need to do clearly is to accelerate the pace of development as we pursue that ambition to be the provider of choice of technology and technology-enabled services in our chosen markets. So the strategy is really built around 4 areas. The first one, clearly differentiation of technology products and technology-enabled service offerings that are scalable and repeatable, and where we can have ownership of intellectual property. Effective customer engagement through sales and account management. And one of my personal objectives is to make sure that every one of our customers is a reference customer, so that we know that we could go to those customers and they would speak highly of Xchanging. The third element, of course, is a competitive cost base, which is an appropriate mix of onshore, nearshore and offshore resources and capabilities. And the focus really of offshore is very much around not so much the fact that it's low-cost arbitrage, but more around developing capabilities in those offshore locations at an effective cost. And then finally, of course, talent. We need to be recruiting and developing and retaining talented people. So you will have seen this before. It's the building blocks of our business. So we see business processing services, or BPS, which is largely built around the insurance market and banking and capital markets. We see that as a sort of annuity of revenue, profit, cash flow. And so it's something which is predictable and stable and earns good margins, as you've already seen. The technology and procurement businesses, clearly we've invested significantly in those and have refocused those businesses, and now they're starting to emerge. And those, of course, are in the faster growing markets for us. So we would see potential for higher growth and margin expansion in those businesses. But of course, they will inevitably carry a higher risk profile. So more specifically, around business processing services, the focus is very much around complex processing and technology enablement, because that's really where the value add is. That's where we want to really focus our business. And of course, within the London insurance market, the Bureau service is a good example where we provide the technology and the processing around that technology. In the technology services business, the focus is very much around insurance software, so development of a global insurance software offering which has local application in many national markets and covering software for retail and wholesale brokers, insurers, reinsurers, managing agents, and also with the addition of the insurance associated with the provision of claims in the health area. And in application services, it's about application development, testing and support for, could be bespoke offerings. So this is where we do custom applications and systems integration, maybe enterprise offerings. So these could be packaged applications, for example, in logistics with Oracle Transport Management, product lifecycle management, where we partner with Dassault, and of course Zuba post-implementation. Or platform offerings, which is invariably sort of outsourced product development. This is where we would develop product on behalf of customers. And within that application services business, we do have a number of domain strengths around manufacturing, real estate, logistics and insurance. But it is a business that actually can be industry agnostic in the sense it can work across a number of different industries. And then in procurement, the focus is very much around the application of technology and using that technology to wrap services around the technology. So I mentioned earlier on, we've invested in, for instance, contract lifecycle management, supplier relationship management, spend analytics around the original market maker for technology which we acquired. And we've also looked very closely at the offerings. And so those of you who attended the Investor Day when we covered application services and also the procurement business will recall that we're trying to build the offerings around software as a service, which is driven by Market Maker 4, and procurement as a service, which is providing a managed service around the technology, and then tail end spend management. And some of the major awards that David referred to are actually in that tail end spend management area. So, with the transformation complete, I think we now have the new Xchanging. We expect to see further growth in application services. We expect to make real meaningful progress the insurance software business, and we expect to prove that we've turned the corner within procurement services business. And at the same time, to continue to protect and grow the BPS foundation of our business. So we will see, as David suggested, reductions in the BPS insurance revenue in 2015 as a result of the full year impact of the 2014 changes. But we can predict the impact of those reductions. And we expect that, as with 2014, as David mentioned, the BPS business will be able to protect the margins from the impact of the revenue reduction and position that business for further growth. So just a few specific areas that we're going to focus on as we go through 2015 to really drive the achievement of those overall objectives. So in BPS, a big focus around net sets. So we've got the RSA implementation going on currently, and we've also got the pilot going on with Rushlicon, which is the standards organisation for the insurance market. Binders 360 and Binders Cloud, very exciting area for us. So Total Objects brought with it this concept of the Binder Cloud, which we can supplement to our Binders 360 offering. And it enables us to develop what we call a delegated underwriting service for the insurers. So that's a very important area. And then in financial services, we need to finish what we started with the transformation of the business in Germany now that we have 100% ownership. So that really involves bringing in some new product offerings in that business, but also through automation and cost optimization, just improving the efficiency of the business. And then now that we've completed the integration of the businesses in Italy, really to pursue a strategy for growth in that business. And in addition to that, in financial services, we're trying to focus around some specific offerings like Know Your Customer, and also, which is in fact done in conjunction with a company called Esphonic, and then wealth management software in connection with a business called Finantic. So we want to build on those partnering relationships which we have developed. Clearly in technology, we want to see Zuba wins, and certainly the objective is as we go through 2015, we will see a number of those Zuba wins. And I use Zuba in the sort of total context, Zuba including Total Objects and also including AGENCYPORT. We expect to see continued development of that business and to focus increasingly, for instance, on IoT and education platforms, and actually to prove out those offerings. And we would expect to see further growth in revenue margins in the application services business. And then finally in procurement, David referred to the substantial business wins that we made towards the end of 2014. The key for us is to deliver effectively those opportunities, because having won them, we now have to deliver behind them. So there'll be a big focus on that. The continued development of the technology platform, because there are a number of things which we still need to fill in terms of that platform. And then, of course, the integration of Spikes, which, as I mentioned, we announced today that acquisition has now been completed. And in fact, it's one of the businesses where we found the speediest sail in the history, I suppose, of acquiring those businesses, because even before we'd actually announced the completion of the transaction, we heard last night that they'd been very successful in concluding a sale with an investee company of a private equity business. And this is very much a specialised area around analytics, which will supplement the procurement business. And I think that will be a very exciting complement to Market Maker 4. Finally then, just to summarise and a couple of words about the outlook. To me, as I've said, the transformation journey is now complete, and now it is time to see a resumption of growth in our business, growth in revenue, growth in profitability. So in 2015, we will see further progress towards our aim of being the provider of choice of technology-enabled services in our chosen markets, capitalising on the strengths of the whole organisation. We'll keep up the pace and speed of development in 2015 with the objective of seeing underlying and absolute revenue and profit growth in the business, a return to stronger cash generation now the significant investment is behind us, and of course generating returns on those investments we have made. Our strategy is well defined and understood, our offerings are better, our organisation is clearer, we have talented people and good management. We're all committed to delivering growth in revenue, profits and cash flow, and aiming to further strengthen our business. So at the start of 2014, we committed to delivering growth in revenue and profit in 2015, and we're sticking to that commitment. And since the start of the transformation journey in 2011, we've delivered what we said we would in each of the years, and certainly it's my intention to do the same for 2015. Thank you.
Thank you very much, Ken. Thank you, David. And now I'd like to open up both the floor and the conference call to questions. We've got some roving mics here. I'm going to repeat questions just to make sure that we capture it for those watching on the webcast. So if you could just give me a moment to repeat your question. So perhaps give them to me individually, not sometimes people like to ask 3 questions at once. Perhaps if I could take them individually and just wait for the microphone to come along. Alex, you have one.
I was going to ask 2 questions actually, but let me just do them one at a time. On slide 32, you have your 2013 to 14 adjusted operating profit walk. The second column there is the impact of revenue growth, and you've got an increase in operating profit of about 18.8 million, which is a margin of just about 50%, probably a little bit over. Would that be a good indication of the kind of margins you can achieve on incremental revenues?
Okay, so thank you, Alex. So that's a question about whether the incremental margin improvement is sustainable on revenue growth.
Shall I take that? So, thanks, Robin. I think if you look at the margin in those tables, it's similar actually to last year's tables. It's slightly higher. What you need to also take into account is actually the cost reduction piece that's shown and the other adjustments that go through that bridge. So it's not a perfect science. Certainly we would expect incremental margin in some of the businesses to be very high. We would. It kind of depends a little bit on the business segment we're looking at. We've invested heavily, for instance, in the MM4 business through 2013 as it scaled up. So as we now bring in additional revenue in the MM4 business, it's at very high margin. It more or less drops through. But that certainly wasn't the case for much of the period. It varies enormously depending on the business. If you look at it the other way around, if you look at the revenue reductions, for instance, in the insurance business, generally it has been, and it will be the same through 2015, in relatively low margin areas rather than the higher margin areas, claims adjusting being the exception. So what you end up with is a business that is very much more of a platform-based business. Therefore, you're going to get pretty good margins for new business that comes through. The exception to that is application services business, which is much more of a traditional application service. You know, we call it ITO type business that achieves very good margins, above average margins, but you don't get the super margins because you're not selling so much IP. So as we transition to more and more intellectual property-based sales, I would expect margins to keep increasing. But it will vary a little bit depending on the business we're in. Yeah.
Understood, thank you. And the second question I was going to ask was, on slide 40, you show the AGENCYPORT Europe and the total objects contributions, or what we generated in 13 and 14. There seems to be, in both cases, a good increase in margin from one year to the other. And in AGENCYPORT Europe, actually, there will be a very strong second half margin, which would have been more under your guidance. Should we assume that that there is more scope to increase those margins further as they hopefully come under your control?
So that question is about the outlook for margins in the two insurance software acquisitions we made in 2014.
So I think particularly on the sort of the second half margin, I don't think we would frankly try and take credit for that. I think frankly it's a very good management team that we've acquired with the management business, with the business, as we said at the point of the acquisition. They've done a very good job in frankly very difficult circumstances with a lot of distraction from the CMA process. Done a very good job of serving their customers and delivering a good profit. It could have been quite different, and it's helped the group frankly as a whole. So, but I think we do think that the combination of the three insurance software businesses that are in different markets selling slightly different products with different life cycles, it's a nice complementary set of products through Total Objects, AGENCYPORT Europe, and with the Zuba business as it was. So they're in slightly different markets, they're selling different sorts of products, and there's a very different product life cycle on the three businesses. So they should complement each other very well. And that's the feedback we get from customers. We need to get through the CMA process and actually start helping insurance companies to deliver their aims, which we're hampered with at the moment.
Do we have any other questions from the floor? Will? Over here.
Two, but I'll ask them separately as well. First of all, on free cash flow, you've given an indication on working capital from BAE, and you've given an indication on the exceptionals. Can you talk through what the expected CapEx is and how that's likely to be split, and whether there are any other items like deferred consideration that we should be aware of that we expect for this year?
Yeah. So in terms of CapEx, I'd previously put up a slide that said we expected that to be around 50 million in 2014, dropping to around 25 million with a split in 2015. Expectation is the total is about the same. We did slightly less than 50 in 2014. I think we'll do slightly more than 25 in 2015, but overall about the same. And in terms of the split, broadly the same as on those slides. So I don't think there's any real change in that sense. And it means that the capital investment cycle in the business in 2015 matches more closely depreciation and amortisation than it has in the past. They're now more or less evening out through 2015. Will, what was the second part of your question? Sorry.
So whether there's anything else we should be aware of for free cash?
Deferred consideration.
So deferred consideration, there's a slide in the on acquisitions in the back of the appendix which is an update to the one that we showed at the half year, which shows the phasing around deferred consideration. So there are payments through 2015 relating to acquisitions, in particular MM4, which are in the schedule. Other than that, I don't expect to see other significant cash variations. We'll do what we can to try and make up the negative impact from both the BAE Systems working capital outflow and the rationalisation costs, some of which obviously should come back to help us in the year because of cost efficiencies. But those are significant movements in 15, and by their nature you can see that they won't recur in 16 because we don't plan to have exceptional restructuring costs in 2015, and obviously the working capital outflow on the BAE contract can't recur because the contract's gone.
And, sorry, one more quick one. It's on procurement. You clearly won a lot of work in procurement this year. You said the drop-through margin on that is extremely high. What margin should we expect for that business in 2015?
So it's just a question about procurement and the sort of outlook for margins on that business as we go into 2015.
So I think the procurement business, in terms of its different components, the highest margin piece we would expect to be the software as a service, as you'd expect. Then the services that add on to that, so procurement as a service, then tail spend management, and then more traditional procurement outsourcing. If you went back 18 months ago, the business only had traditional procurement outsourcing. And one of the reasons why we've refocused the business is obviously because it was challenged on margins. So we would expect the margins to improve, as we wouldn't expect the business to be loss-making in 2015. The one thing that was done very well through the transformation of the procurement business was that Salesforce was retained. It's a very significant cost of sales in that business. And what that meant was that we sold an awful lot of business in the procurement business in 2015, which didn't really contribute to revenue, which didn't contribute to revenue in 2014, but will start to do so in 2015. So if we see the success and growth in the procurement business, particularly in the technology end and tail spend management that we expect, we'll keep investing, and that could impact margins. But we certainly, as Ken said, we turned the corner in procurement, and we certainly expect a significantly better performance in 15 and then certainly 16.
Are there any other questions? Robin, we have a question here.
Just looking at Zuba, can you give us some more detail on the pipeline of contracts coming through? Are you intending, given some of the issues that we've had with the sales process, to partner with others, with other integrators, for example? And I've got a follow-up.
Okay, so that question was about the pipeline for Zuba contracts, how that's looking, whether we're looking at any partnerships possibly to develop that.
Okay. The Zuba pipeline remains a strong pipeline. The real challenge for us is clearly getting the conversion of that pipeline into revenue. So what we've been certainly doing over the last 3 or 4 months since Chris Baker took on the overall management of the business, so Chris joined us from Oracle, is to really focus on some very, very specific opportunities, what we would consider to be sort of will-win opportunities, and really put time and energy into those. It's a long process, and what he's effectively done is he's gone through and categorised the various opportunities in the pipeline. Because the challenge with the pipeline, of course, is we can define what we know as potential buyers in the market, then you can qualify those buyers. But ultimately, because of the size of the investment that's needed with the Zuba product, actually getting some of those customers across the line is a long process. So I think we're quite happy with the fact that the opportunities are there, that we've got qualified opportunities to go after. We do actually partner with, so for instance, Deloitte is one of our channel partners. They get involved in doing some of the implementation. We do believe, incidentally, that once the Everest installation is complete, which we think will happen in May, June time, that will be a great advert for us in the US market, because a lot of the opportunities, of course, are in the US market. And we know that a number of potential customers are out there looking at the progress of that particular opportunity. So I think it's clearly challenging. It's a bit of a disappointment that we didn't get more conversions last year, but the pipeline hasn't actually reduced at all. And as I mentioned in the remarks I made, it's not as if the opportunities have gone anywhere else, because no one else actually won them. They've clearly, some stage, somebody will win. Hopefully it will be us. Some of them, of course, will be competed as well. So they're not necessarily individual sole-sourced opportunities. Although where we're looking, for instance, at upgrades, then clearly there's a lot more potential for us to have those coming our way rather than necessarily going to competitors. What was your second one?
And perhaps you could give us a flavour of your thoughts on future acquisition priorities. You've still got quite a bit of debt headroom there.
So that question was about our thoughts about any future acquisitions.
Well, I think on acquisitions, I've always said actually that what we want to try and do is to fill in where we believe we've got gaps, strategic gaps, rather than just bulking up. I think the Spikes acquisition is a very good example of that. So although it's very small, it was important to supplement what we were doing with the technology platform within the procurement business. So to the extent those sorts of strategic gaps exist, then acquisitions are likely to be in those sorts of areas. Typically they're going to be a business that's got some technology that we'd like to acquire, probably going to be an owner-managed business, relatively small size, and it's likely that when we make those acquisitions we'd want to put them on some form of earn-out arrangement, and that's been the pattern so far. I mean, obviously the exception to that was AGENCYPORT.
Any more questions from the floor? And any questions on the phone? No? Okay. Well, in that case, I'll draw the formal proceedings to a close. Thank you all very much for coming to join us this morning. Clearly, Ken and David will be around now for a bit, so if you want to come up and talk to them informally, you are most welcome to do that. Otherwise, thank you so much, and I'll draw the meeting to a close. Thank you.